So in today's class we will talk about real options, and in this topic we will build on the concept of options that we talked about in the last few segments. Okay, so what is a financial option? What's a financial option? Yeah, so a financial option, the example you just gave is a call option. So a financial option is an option where the underlying is some financial asset. What are financial assets? Stocks, bonds, for example, are financial assets. So any option where the underlying is a financial asset is called a financial option. In this class, we are going to talk about real options where the underlying is not a financial asset. The underlying is going to be something real, something tangible. Okay, but these are a little harder to understand. So for the first 10 minutes, you just go with the flow. And after 10 minutes, this stuff will all start making sense. Okay, first I'll just read out a few things. Real options exist when managers can influence the size and riskiness of a project's cash flows by taking different actions during the project's life. Alert managers look for real options in projects, and smarter managers try to create real options. And as you will see shortly, this stuff will make sense after 5 to 10 minutes. Now, how are financial options different from financial options? The payoff for financial options are specified in the contract. How? In a financial option, we have a certain strike price, say strike price of 70. Then what's the payoff at maturity? If the price of the stock is 80, then what's the payoff? It's 10. So the payoff is very clear in a financial option. As we'll see, in a real option, the relationship is not as obvious. Real options are found or created inside of projects. Their payoffs can vary. Okay, now let us try to understand what we mean by real options. One example of a real option is a investment timing option. And let me try and give you an example of this. Let's say that you are here at time 0 and you have developed a new product that will revolutionize the telecom industry. Okay, it is some gadget that you can attach to a cell phone and make it do something special. Okay, now you are excited about this product. It will cost you 100 million to build a plant that manufactures this device. But what do you think the risk is? After spending this 100 million, what's the risk? Yeah, what if the market does not accept the product? Okay, so you can spend the 100 million, and very simplistically, there are two scenarios. One scenario is that the product is a success and you can generate immense cash flow and have a very positive NPV. So that's the high demand scenario. And then the other scenario is low demand or very little demand. Okay, in this case, let's say that the sales are extremely low. So what's the problem with this scenario? The problem with this scenario is that you have already sunk the 100 million. And now if nobody is buying the product, then you will obviously not be very happy. Okay. Now, let's say that you have an option of going to our telecom regulatory authority, the PTA, and you can buy a patent, or you can essentially patent this device of yours. And essentially what that means is that you have 1 year in which time nobody else can create a similar product and enter the market. Then what do you think you will do over this 1 year? Okay, that's complicated. What do you, as in, especially the marketing people? What the market? No, but you are not. So, any other idea, especially marketing people over here? Okay, if it were that easy, then everybody would just create a monopoly. Okay, the point is, what are you unsure about? You are unsure about the demand. So to try to ascertain demand, maybe you just create a small prototype and you assess market demand. So rather than investing the 100 million at time 0, in a small lab you create a few and then you do some test marketing. Does that sound familiar? So over the 1 year period you try to assess demand, and let's say that you determine that the demand is great. Then what will you do at the end of the year? Then you invest the 100 million. And if you ascertain that the demand is not too good, then what do? Then you do not invest. So let's say that the cost was 2 million to lock in this period. If you do not do this, if you do not patent this, what's the risk? That the risk is that somebody else can come into the market and take over. So while you are busy doing your market research, somebody else comes in and you figure out the market demand is great, but somebody else comes in and starts capturing that market. So what is the advantage of spending the 2 million and giving yourself 1 year to do some more research and giving yourself the option to start or invest the 100 million 1 year later? Is there value in giving yourself that option? There's immense value. Why? Because then you can, what will you do at this point? You will only spend the 100 million if the market demand is going to be high. Okay, now, do you see a rough analogy between this and financial options? Yeah, this is sort of like a call option in the sense that what is the maturity period of the option in this example? It's 1 year. Under what circumstances will you quote unquote exercise the option? So Kinza, what does exercising the option mean? Yeah, so in the financial option world, exercising an option meant buying the underlying stock. In this context, what does exercising the option mean?
Go ahead with the project.
Exactly. So in this context, exercising the option would mean spending the 100 million and going ahead with the project. Under what circumstances would you exercise the project, Nabiha? Exactly. If the feasibility report is favorable and you anticipate high demand, then you will exercise the option, and we can say the option is in the money. Under what circumstances would we say that the option is out of the money? Yeah, if you determine that it's not feasible, then you do not exercise the option. Next, what is the price of the option? So analogous to the option price. Yeah. What is it? 2 million. So at time 0 you spend 2 million to lock in this option. So that is 2 million. So that is the amount. So that's the option cost. Okay, so I hope you see the analogy, and this can be quite powerful. Essentially, all of this class will be the applicability of option theory to a real world scenario. So even if you are not a finance major and you are wondering why am I studying options, then in the real world there are examples of this. How many people here are marketing majors? Okay, so marketing majors can relate to this very well. Okay, so when you want to market a new product, do you immediately build a huge plant and just start marketing it, or do you go through phases? You do some research, you do some prototype, you do some pilot studies, and so on and so forth. Do you realize that effectively what you are doing is giving yourself options? So when you do a research analysis of whether this product will be accepted, you are spending a small amount of money to figure out whether there is demand or not. Then you do a test marketing exercise. There again, you are spending less money to figure out whether this product will sell or not. So whether you realize it or not, you are using option pricing theory underneath all of this. Okay, what are some other options or examples of real options? So far you've understood one example of a real option. Why is this called a real option? Because what's the underlying here, Omar? The underlying is a real physical project. That's why it's called a real option. Honey, in my simplistic example. Yeah, so this is how much you paid upfront for it. This is a good question. In the financial option world, that piece of paper has a market, that option has a market, and you can buy and sell that in the market. In real options, it's not the same way. It's not a traded piece of paper. In fact, it might not even be a piece of paper. Okay, so this is a it's a decision, or it's something that is very internal to your particular organization, but it has a lot of similarity with financial options, which is why we are studying it. So this option is an example of an investment timing option. What are some other options? Growth options. Expansion of an existing product line. So let's say you have two businessmen, one who has not taken this course and a person who has taken this course. Okay, now both decide to set up a plant to manufacture widgets. Person A buys this property and builds the plant on the property, but it is rigid in the sense that if demand is high, he can do nothing about it. Person B builds a plant, but next to the plant, he also buys some extra property which gives him the option to expand if the demand is high. Okay, so essentially what he has done here is given himself an expansion option. Now, what is the option? What is the price of the option? It's the extra price that he paid for this. What's the advantage of having that extra land next to his plant? That if he wants to expand, he will expand. Now, what would you do? Just blindly go for B, or would you go for it based on some analysis? Yeah, based on analysis. What analysis? The analysis would be what's the cost of this expansion relative to what's the benefit. Okay, so you won't just blindly go into it. Hopefully you will do that analysis. So what's the difference between A and B? A might not even think about it. B explicitly thinks about it. That's one good step. But to really make that good step useful, you just also do the analysis of whether it makes sense or not. So this is an example of a expansion option. New products or product flexibility. So here I'll give you a simple example. Let's say about 15 years ago, BMW set up a car manufacturing plant in the US, southern part of the US. At that time, most people would drive regular sedans, okay, four-door, four-wheel, regular sedans, which is the typical car that we see here. But there was the possibility of a growing interest in sports utility vehicles, SUVs. So what BMW did was they spent some extra money to make the plant flexible enough that if the demand for SUVs takes off, then they can also manufacture SUVs. Do you think that added flexibility cost them more money? It cost them some money, but what was the benefit of that added flexibility? So the benefit was that when they made the decision to make the plant more flexible and spend X million more dollars, did they know that the demand for SUVs would take off? They were not sure, but when the demand did take off, they were ready. Okay, so they must have done a cost-benefit analysis that it costs us X million more to build, but if the demand takes off, we can make 10x profit. Okay, so this was an example also of an option that was built into the project. Now, one of the things that I read earlier, smart managers create options in the work that they do. So if you design your work well, your project well, you put options into the project that can be of immense value. But obviously the key is understanding the cost of the option, which we will quantify later in this lecture, and quantifying the potential benefit of those options. What is an example of options related to new geographic markets? Exactly. So you are going into a new market, so you are expanding into Central Asia. Do you just go and set up a huge plant over there? Or do you go spend some money, conduct research, so that's all money spent, maybe set up a small satellite office over there, and based on that output, or based on what you figure out, you only expand after that if the results are favorable. Okay, so what is that an example of? So that is again using options, giving yourself the option. If you don't even do that, then you are not even giving yourself the option to exploit growth opportunities in Central Asia, for example. Okay, some other options, and the material that you are studying here can actually be applied in almost any discipline. Imagine you become a procurement manager at Engro. What's a procurement manager? Are you? Yeah, so you purchase stuff. That's the fancy term for a guy who purchases, is a procurement manager. Okay, so now at Engro you are a procurement manager. What do you think is your biggest procurement? Gas. Okay, so biggest raw material is gas, and let's say that we are living in an integrated market and you get gas not only in Pakistan but you also, there are issues with gas in Pakistan, so you approach foreign suppliers of gas and you want to lock in a 10-year gas contract. Okay, gas is a commodity, price fluctuates, you want to lock in a price. I don't know the price of gas, but let's just say that it's $100 per unit, okay, just as an example. Now, one scenario is that you lock in a 10-year contract and that contract is at $100 per unit. Then given the volatility of gas prices, let's say that when you did this contract, the price of gas was $110 a unit, but 2 years later, the gas price comes down to 90. What will you do? You will kick yourself. Okay, why? Because you have locked in a 10-year contract at 100. Being ethical, you cannot walk out of your contract. So you are stuck paying 100 for a commodity that you could get in the market for 90. Now, if you are smart, and given that you've taken this course, one of the things that you can think about when you create the contract is put an option in the contract that you can cancel the contract with a 6-month notice. Okay, let's imagine that your counterparty, the entity you are dealing with, is not smart enough, and you sugarcoat this cancellation option by saying that instead of $100, let's just make it $100.50. So I'll give you a little more, but you allow me to just put in a cancellation option where I can cancel the contract given a 6-month notice. Okay, now at the time with high gas prices, it might seem like a nothing addition to the contract. But what's the value of that additional clause? The value is this, that over the 10 years, if the price comes down, let's say new gas reserves are found, supply goes up, price comes down, that little clause in the contract is immensely valuable. So again, smart managers create those options when they make business deals. Okay, so that's a cancellation option or a temporary suspension option. Okay, now obviously if you understand the value, then if the counterparty tries to have a cancellation option, you make them pay for it. In the sense that you say, okay, you can cancel, but it will cost this much. Okay, so
same thing happens in rent agreements.
Exactly, same thing happens in rent agreements. So when you rent out for a long period, if somebody cancels, you need to have a cost. Anyway, the point right now is to understand the value of having that option. A lot of people might not think about it upfront, but you will. Flexibility option, I sort of already gave this example earlier, so you can think about it. So the question is temporary suspension. Now, this is sort of like cancellation. The only, in the Engro example that I'm giving, let's say that instead of cancellation, your contract says that we can, in the 10-year period, we will temporarily not get gas from you for 2 years. You give yourself that option, that we can temporarily suspend. Okay, so the point is that you can get very creative depending on the context and the nature of the business and the nature of the contract. Okay, now what do you think we'll do next? Yeah, so we have understood the business context and you must have been itching for numbers. Okay, so over the next few slides we will try and quantify all this, because at the end of the day, unless you can do the numbers, you don't really know whether something is good or bad. When some marketing person comes and tells you that this product has a great degree of strategic value. It has lots of unique selling propositions. It will add market share and give you all these wonderful marketing buzzwords. Does all that matter if it doesn't increase net cash flow? It doesn't. So ultimately, all business decisions have to be looked at in the context of whether they make money or not. So similarly, any decisions about options ultimately have to boil down to whether it makes financial sense or not. And we are going to look at several procedures for coming up with the value of real options. We'll use a discounted cash flow approach. This was quantitative. Then there's a qualitative assessment of what is it that makes an option valuable. We'll then do a decision tree analysis, and then we'll do a Black-Scholes analysis. Financial engineering techniques are fancy techniques that you need to know exist, but we will not get into them because they are beyond the scope of this class. You just need to know that these things happen. If you go do a master's degree in finance, then you will study this stuff. Okay, so let's understand this through a very simple case. You have a basic project where the initial cost is 70 million. Cost of capital is 10%. Risk-free rate is 6%. Cash flows occur for 3 years. Okay. Now, in this very simplistic example, just to understand the concept, we will say the following. So, you at time 0, you invest the 70 million. And then over 3 years, we have our cash flows. There is a 30% probability that the cash flow is 45, 45, 45. There is a 40% probability that the cash flow is 30, 30, and 30. And there is a 30% cash flow probability that the cash flow is 15, 15, and 15. Does this make sense? Yeah, the point is that it could change, but we are making a simplistic assumption. Similarly, you could say it could end not in 3 years, but 5 years. So you can make this as complicated as you want, but are we here trying to make life difficult or understand a concept through a simple example? Okay, we are understanding a concept through a simplistic example. All right. Now, can you tell me this? What is the NPV of this project or expected NPV of this project? How would you do that? So do it quickly. So this is what you should get. You should get an expected NPV of 4.6 million. How? What is the probability of the 45 cash flow? 0.3 of this cash flow, it's 0.4. This cash flow, it's 0.3. So what's the expected cash flow every year? 30. Where? There is a 0.3 probability that your cash flow will be 45. A 0.4 probability that a cash flow is 30, 0.3 that cash flow is 15. So the expected cash flow at the end of year 1 is 30. And in our simplistic example, what is our expected cash flow for every year? It's 30, 30, 30. So what is our present value of the expected cash flows? It's 74.61, basic stuff that you've learnt. And then what's the expected NPV? It's 74.61 minus the 70, which is 4.61. What's the difference between expected NPV and NPV? Shahrukh. Exactly. So when you use the term expected NPV, that means that there are probabilities of different things happening. And then when you weight by probabilities, which is what we've done here, so this is a probability weighted number, then you call it a expected NPV. If you know that you will get a certain cash flow, then we just call that the NPV. So is everybody fine with this? What's the NPV, expected NPV of our project? It's 4.61. Okay. Now let's look at this situation. So what we are saying is if we immediately proceed with the project, its expected NPV is 4.61. However, the project is very risky. Why do we say that this project is risky? Your name? Yeah. Asim, why do we call this project risky? Okay, demand is uncertain, so you are on the right track. Ayub, can you build on that? Why is this project called risky? Yeah, look, so the basic, even without getting into any buzzwords, if the demand is low, then you have a hugely negative NPV. And what's the probability of this? 30%. Yeah, if there's a 30% chance of losing 32 million, that's risky by any definition. Yeah, so all that is reflected in this negative NPV. Okay. Yeah, so if there's a 30% chance that you will lose 30 million, just remember that that is risky. Okay. Yeah, you have a chance of making a profit. So in other words, if I tell you that there's a 30% chance of you being fired next year, you getting a promotion, was that a good deal or is that a risky deal? For most people, that's a risky deal. Okay, so again, let me put it this way. There's a 70% chance that next year either you hold your job or you are promoted, and there's a 30% chance that you get fired. Would you call this a risky? So just answer this question. 70% chance that either you are promoted or you stay at the company, and a 30% chance that you get fired because you've lost the company 30 million. Would you call that a risky job or a safe job? All right. Okay. Okay, let's move on. Okay, now so anyway, what do we have so far? We have established a couple of things, that the overall NPV is still positive, 4.6, but it is a risky project. Let's say now that you have the following option. If we wait for 1 year, if we have the option, so where are we right now? At time 0. If we wait for 1 year, we can work in this 1 year to figure out whether the demand will be high or low. So we can do some more research. We will gain additional information regarding demand. If after this 1 year we determine that the demand is low, then we will not implement the project. So rather than spending the 100 million over here, we wait. Okay, we tell our boss that, look, this project looks rather risky. Expected NPV is positive, but if the demand turns out to be low, then the project will have a hugely negative NPV. So rather than just spending the 100 million here, let's wait for a year and do some market research. Do you think the boss will like to hear something like that? That would be a very sensible thing to say. Okay, now if we wait, the upfront cost and cash flows will stay the same. So this is a very simplistic assumption that might not be true in the real world. But to illustrate this point, let's say that you can wait for a year and the cost of the project stays the same. And also the subsequent cash flow, let's for a moment assume, stays the same. Okay, now just looking at this qualitatively, the value of a real option is relatively high if the underlying project is risky. Do you recall for an option, a call option or a put option, options in general become more valuable when the underlying is more risky or volatile. What's the underlying here? The project. So just qualitatively you can see that if the underlying project is more risky, then the option to wait for a year is going to be more valuable. The other point is, when you were talking about financial options, what was more valuable? An option that is expiring in 1 month or an option expiring in a year? In a year. So the longer the time that you have to exercise an option, the more valuable the option. In this context, what is the maturity period of the option? 1 year. Muhammad Ali? Taha. What's the 1 year? So the time period for the option is 1 year. Why is it not 3 years? 3 years is the life of the project. Okay. So this particular project is risky and has 1 year before we must decide. So the option to wait is probably valuable. Okay. Now Haneen, then Umar. Okay. So we are actually going to quantify the value shortly. So just hold on. Right now we are just doing a simplistic analysis. Umar?
Sir, next slide. If you
okay. Now, okay. So let me do this. These questions will get answered based on what I'm going to do next. Right now I'm just giving you, high level words, but you are going to see numbers. So just bear with me, hold your questions for the next 10 to 15 minutes, and then after that we'll have a QA session. Okay, now we are going to analyze this project using a decision tree analysis. So you are sitting here at time 0, which is the year 2003, and you have decided, or you have the option to wait for a year. So rather than investing the 100,000 or the 70 million at time 0, you can invest 70 million at the end of year 1, which is 2004 in our example. Okay, sitting at time 0, what do these probabilities represent? Yeah, these are the probabilities of 3 possible demands. Now, sitting at time 0, do you know that there's a 30% chance that you will have a high demand? So that means there is a 30% chance that you will invest the 70 million, and then the sales or the cash flow will be 45, 45, 45. Okay, there is a 40% chance that the sales will be, or cash flow will be 30, 30, 30. And there is a 30% chance that you will have low demand. So that means if you know at time 0 that there is a 30% chance of low demand, once you figured out that there is low demand, would you build the plant for 70 million if there is low demand? No. So do you see why this is 0? Yeah, because even though you are not here, you are at time 0, but you know that there's a 30% chance that there will be low demand, and in the low demand scenario, you will not be silly enough to spend 70 million on the plant. Okay, now.
Sir, if the project would have a positive NPV, low demand,
then you would do it. Okay, then we would not even worry about waiting. Okay, now what's the NPV of this scenario? The first scenario, going 30% chance. The NPV at time 0 of this cash flow, okay, it is 35.7. It's based on 70. Where is this? Why are we discounting this at 1.06 and then the others are being discounted at a? Okay, the reason is, and this is tricky, where are you at time 0? You are investing or spending 70 at the end of year 1. Are you sure you will be spending the 70? So if the demand is high, you are sure you will make that investment. When you are sure that you will spend some money, then you should use the risk-free rate to discount that cash flow. Why? Because you are sure that cash flow will happen. When you are sure about something, then you can use the risk-free rate to discount.
Why not the interest rate?
At least.
Okay. Okay, so just let me just finish the flow and then I will respond to this. Okay, so are you sure about spending the 70 in the high demand situation? You are. What about the remaining cash flows, plus 45, 45, 45? These are uncertain. So these you discount at the riskiness rate associated with this project, which is 10%. So these cash flows are discounted at 10% as shown over here. But the 70 investment is discounted at a risk-free rate. Now, in case, do you think this is being prudent or this is being risky? So, if you are spending 70 after year 1, what will give you a higher number? Discounting at 6% or discounting back at 10%? This is a negative number. 6% will give you a higher expenditure. So this is actually discounting at 6% is more prudent because that is increasing your cost. And you know that 70% is, this 70 million is going to be an expenditure. So you discount the 70 at 6%, whereas the 45, 45, 45 are discounted at a higher rate. Notice that these are plus positive cash flows, and given their riskiness, you are discounting them at a higher rate, which is the present value is low or high. Given that you are discounting at a higher rate, that makes their present value low. So that again is conservative or prudent. So the NPV of this scenario is 35.7. This is NPV at time 0 or time 1? Time 0. Similarly, when you find the NPV of this, what do you think you will get? Can you do it for me quickly? Of this second scenario? So it will be 70 over 1.06 plus 30 over 1.1 squared. So tell me quickly what that number is. Okay, so let's say this is 1.7. So notice it is a positive NPV, so that's why we are building the plant even if we have medium demand. And if there's a 30% chance that the demand will be very low, in which case what do? So what's the NPV of this? 0. So what is the expected NPV at time 0 when you have the option to wait for a year? How will you figure out the expected NPV at time 0? So what is the expected NPV at time 0 given that you have the option to start the project after 1 year? So it would be 0.3 into 35.7 plus 0.4 into 1.7 plus 0.3 into 0. Okay, so this has a NPV of 11.4 roughly. Okay, has the NPV increased relative to the earlier scenario where we started the project upfront? Okay, so isn't this creating more value? Okay, so let's look at what's happening. So 11.4 you just calculated based on the numbers we came up with. So notice that the decision tree NPV of 11.42 is higher than the NPV of 4.6. Where did this come from? This was when we just start the project on day 0. So clearly if we have the option to wait for a year, then the value of the project is more. Now let's say that you were not getting that option for free and you have to go to the government and get a exclusivity right or some sort of a patent for 1 year that no competitor will be allowed to start marketing this product in the 1 year period. Now that exclusivity costs some money. Up to how much would you be willing to pay for that exclusivity given the calculations that we've just done? Yeah, so the difference between these two represents the maximum you are willing to pay. Okay, now if you go and the government demands 7 million to give you exclusivity, would you buy that option? You will not, because the cost of that option is greater than the benefit. Okay, now when you go to negotiate, will you just blurt out how much you are willing to pay? No, you will still try to get the best possible deal. And if that exclusivity right costs 2 million, will you go for it? Then you will, because the benefit that you will get by having the option to wait is more than the cost of the option. Okay, so pretty powerful if you think about it. Okay, so the option to wait, that has a worth of 11.2. So anyway, we've gone through all this. Okay, do you notice that the option to wait changes the risk of the project? So Sidra, how does it change the risk of the project? Does it make the project more risky or less risky if you have the option to wait? Why? Exactly. So you make the project less risky by cutting out the scenario where there is low demand. In that case, you then do not invest the 70 million once you figure out that it's low demand. So that is the key point. The cash flows are less risky under the option to wait. Since we can avoid the low cash flows, also the cost to implement may be, okay, the cost to implement may not be risk-free. The 6% that we used may not be risk-free, but you know, we've simplistically assumed that that is a guaranteed investment, which is why we go with 6%. Given the change in risk, perhaps we should use different discount rates. What is this saying? This is just trying to give you some more finance theory. The risk-free, the rate that we use to discount, should it depend on the risk of the project? It should. So if we are making the project less risky, then should we use a higher discount rate or a lower discount rate? A lower discount rate. So, but what lower discount rate should we use? We have not. Is it risk free? It is not really risk free. So actually we do not know enough, or finance theory has not evolved to a level where we can figure out that exact rate to use. So we just sort of be prudent and use the 10% that we were using originally. Okay, not much more to it. Okay, now finally the most exciting part of this class, where we will use Black-Scholes. All right, I'm sure you were waiting for this. With Black-Scholes, what were the inputs?
We didn't factor in the cost of research.
The
Cost of research.
the point is that we did not factor in the cost of research. Good point. We actually did not. Okay, so since you are at it, just one larger point and then some associated points. When we learn something new, okay, what we generally try to do is create a simple model to illustrate the one concept. Let's spend 3 minutes poking holes in what we just did, just for the fun of it. Okay, so we have made several assumptions. We have made an assumption that, and I'll just, I'll do you a favor and poke the hole so that you don't keep poking holes. All right. So, A, we are assuming that you can wait for a year and spend the same money. B, we are assuming the cash flow will be the same. C, we are assuming the cash flow will end after 3 years. D, we are assuming that there is no cost of figuring out. So you can go on and on and on. Okay, so there are several issues. But the point is that we are learning the concept of real options. So we are putting out all these other things on the side and coming up with this. Even famous people like Modigliani and Miller would do this, right? So they would make several assumptions and come up with a theory based on that. But then you can relax one assumption at a time. So for example, can we enhance this model to build in the cost of research? That's not too hard. Can we enhance the model to change this cost? We can. Can we enhance the model to make these different cash flows? Can we enhance the model to have more cash flows? So you've learned all these things. So is it, we can spend 2 hours making a complicated model and not learn anything new? Or we can just create a simple model, learn the new concept and move on. That's what we've done. Okay, so now Black-Scholes. What are the inputs to Black-Scholes? So way back, relaxing over there. What's the name? Adil, yeah. So what are the inputs to Black-Scholes? So input to Black-Scholes are exercise price. What do you mean by underlying price of the stock? Yeah, the price of the stock, or what else? The standard deviation of what, or the option or the underlying? Now your name? Zulfikar. Standard deviation of what? Yeah, it's a standard deviation of the underlying. What else? Awesome. The time to maturity. So that means if we figure out these 5, we can simply plug into Black-Scholes and get the answer. What is, so somebody, Hussein, what is X in this context? It's strike price. So what's the strike price here? Osama, what's the strike price? Why? Is 70 the price of the option? So, of what? Okay, so you're right, 70 is the exercise price. Why? Because what is exercise price? That is how much you buy the underlying for. In this context, the underlying is the project. So you get into the project by spending 70. Right? So you spend 70 to set up the plant, just like you might spend $70 to buy the underlying stock. So X is 70. Okay, what is P? Oh, actually, before P is a little tricky. Yeah, actually, let's do it in order. What's P? P is the price of the stock. What is the stock in this context? It's the project. So P Anybody who's feeling smart wants to tell me how you come up with P?
Total cash flow.
The present value.
It's the present value of the future cash flows. Is that the same as NPV? No. It's only the present value of the future inflows or the future cash flows. So how do you value a stock? You might have studied this in IBF. It's the present value of all the future cash flows. Similarly, the price of the project is the present value of the future cash flows. How is this different from NPV? Good. What do you think, Sunera? Year zero. You are doing all the analysis at time zero. So ultimately you will be doing all your analysis based on time zero. Okay, so that's P. So Larib, what's this sigma? Sigma is what?
That's the standard deviation
Of what?
of the present.
Exactly. So this represents the variability of the cash flow. Afan, what's T?
The time.
Of time for what? What's it in our what's it in our example for Black-Scholes? Will we plug in 3 or 1 or yeah? It's not the time for the project is a 3-year project, but the option is a 1 year. Okay. So Falak, are we treating this sort of like a European option or an American option? European, because we'll exercise after 1 year. Risk-free rate is 6%. So what was your question, Afan?
Difference between NPV and the present value P.
Okay, Omar, can you respond to that? Afan is asking what's the NPV and PV. Exactly. Okay. The price of a stock or the price of a project is defined as the present value of the future cash flows. That's what the present value of a project is. So how much is the project worth? What's the value of a project? The value of a project is the present value of future cash flows. Okay? Yeah. Yeah, it's the sigma is the variation, and we are going to calculate it. Sigma is a measure of the variation of the underlying. Now exactly what that is we are going to come up with. Okay. So now we have sort of figured this out. Can you just concentrate on the screen over here? What are we looking at? Do we know X?
Yes.
Do we know the risk-free rate? Yes. We know T. So what are we going to do now over the next 20 minutes? Figure out P, and so we need to figure out P and the variance. Okay. Now how do we estimate P? For a financial option, P is the current price of the stock, which is equal to the present value of a stock's expected future cash flows. The current price is unaffected by exercise. So the price of a stock, is that impacted by the exercise price written on the option? Okay. So Mahin, what will you do for a real option? What's P? Exactly. It's the PV of the future expected cash flows. Do you subtract the cost of the project? You do not. So we've just established that. Okay. Now, where are you doing this analysis? At what point in time, Isa? Time 0, which is right here. So this is where you are sitting. Okay. Now, what are the different, so what are we coming up with? We are coming up with the PV of the different cash flows. There is a 30% chance of this scenario, of these future cash flows. And what do you think this means? This is the present value of the present value at what point? So this is saying that the present value of these cash flows in 2004 is 111.9. What does this represent? This is the present value at the 40% probability that we have this cash flow. And then what's this number, 37?
At low demand.
So if there's low demand, then the underlying will be worth only 37. Okay. Now, all these numbers are at year 1. We want the stock price at year 1, or in Black-Scholes we plug in the stock price now. So you are sitting over here at time 0. So what is P at year 0? So what can you tell me? Can you calculate? So we have these three. Okay. So again, are these guaranteed numbers or? So they are probabilities, and even so the discount rate that you'll use is 10% actually. So using a discount rate of 10% and these three numbers, what should P be today? Okay, actually you have these three scenarios. Aren't you going to use a probability weighted number? So
67.82.
very good. Let's see if others can get that too. What you should get is about a time now. So this was a very good question somebody from here asked about whether we are doing this analysis at time 0 or time 1. So this 67.8 is the price at time 0 or time 1? It is time 0. So you notice, where did these numbers come from? These were the three possible present values at time 1. And then what are we doing? We are taking the probability weighted, so that has a probability of 111 has a probability of 0.3, 74.6 has a probability of 0.4, 37.3 has a probability of 0.3. So you take all these, and then why are we dividing by 1.1, Kamar? Why are we dividing by 1.1? We are discounting, so we are taking this expected value and then discounting back one period and getting 67.83. So now what else so on the Black-Scholes set of inputs, we also have P. So what will we do next? So 67.82 is what? So this is our estimate of the price at what time? At time 0. So this is our input into Black-Scholes. Now we are going to estimate sigma squared. What's sigma squared in a financial option? It's the variance of the stock's rate of return. For a real option, sigma squared is the variance of the project's return. Okay, now what are the different ways of doing this? One way is to just use your high level judgment. Another is to use what's called a direct approach, which is what we will spend most of our time on. And there is an indirect approach that's complicated and one that we will not use. Okay, how does judgment work? Let's say that the variance of the stock of the overall company is about 10%. Then the variance of the project that the company does, will it be more than 10% or less than 10%? It will be a little more than 10%. So you use your judgment and say if the company's variance is 10%, then the variance of the project that the company does is somewhere between 12 and 19% based on experience. Okay. Now, since you don't have experience, you are going to use a direct approach, and you have learned how to calculate variances and expected values. So that's what we are going to do. So let's get into this. What was the definition I gave you? Variance is the variance of returns. We've calculated that the price today is 67.8. We've also determined that there is a 0.3 probability that after 1 year the price will be 111.9. There is a 0.4 probability that after 1 year the price will be 74.6. And there is a 0.3 probability that after 1 year the price of the underlying project will be 37.3. Do you remember these numbers? Okay, so in this situation, in the good situation, what's your return? How do we get this? Yeah, from 67.8 to 111.9 is 65%. If you have trouble with how we got this, see Sunil. Okay, where did we get 10%? What we are trying to do here is find the variance. So if you have a given price today and these possible prices 1 year from today, you find your three possible returns. These are the probabilities of those three returns. Okay, and you come up with variance. Do you know how to calculate variance? You studied this in stats, you got this in your last exam, so hopefully you know how to do this. Okay, how do we do it? We figure out the expected return. Where does this come from? 0.3 into 0.65. So this is easy, I hope. And then how do you come up with the variance? 0.3, is this multiplied by 2 or is this squared? So all this should really be squared, and you come up with a variance. Now you should have this feeling of excitement. Why? Because we have figured out all the inputs that go into Black-Scholes. We figured out the strike price. We figured out the risk-free rate is given actually. Time is this. What was P? And what's sigma squared? So what will we do next? Okay, so now you can simply plug this into Black-Scholes. I'll not make you do this. I assume you know how to plug things into a computer. So you can simply plug into this, and then Osama, what will you get when you plug numbers in? You will get the value of the option. Okay, so you can do this and then tell me next class what the value of this option was. Speaking of the next class, you are going to have, so we are done with this chapter now. It was a relatively short chapter. So the quiz and the spreadsheet on this chapter in the next class.